Hello and welcome to the CFRA webinar on cash flow and leverage. This is a deeper look looking at the issues going around at the current time of COVID-19. So welcome everyone to the webinar. My name is Giles Flower. I'm going to be the moderator today. The main presenter is going to be my colleague David Bassett, who's a senior analyst with CFRA. He's been with the firm since 2003. Briefly take you through the agenda for today. I appreciate we've only got half an hour, so I'll quickly go through this. I'm going to give a quick introduction on CFRA as a firm. Appreciate a lot of people on the call are already clients, but we obviously have people who are less familiar with the service and what we can offer, so I'll briefly take people through that. Then the meat of the presentation will be done by David, as I mentioned. He'll be going through a few of the aspects you may see here. And incorporating some live examples from stocks themselves. So he'll be looking at factoring from Treehouse Foods, for example, and reverse factoring from Keurig, Dr. Pepper and Sinopharm. And then he'll be looking at hidden leverage and the comparison of net debt to EBITDA at ACS, the European company there. At the time, appreciate it's only half an hour at the time. At the end, we'll be open up to Q&A. That might be quite limited on time, so if you do have questions, please send them through. There's availability to do that on the chat or directly to us, and we can get back to you if you don't have time after the webinar. As a background to us as a firm, as CFRA, we're looking to deliver actionable research for improved investment and business decision making. Essentially, what we are trying to do is highlight and find companies we think are masking business deterioration through aggressive or creative accounting. As a firm, we are totally independent. We do not run any money. We have no conflicts of interest. Research is all that we actually do. We are a global leader within the forensic accounting, research and analytical world, and also provide advisory services. We've got a proven track record, we're tracking our performance and our ideas of what we're recommending to our clients, and I can give you a bit more color on that as we go through. And we've been in existence since 1994 as a forensic accounting firm. This is a bit more detail on the history. Take you through a couple of firms that we've been owned by. We were owned by Riskmetrics around 2009. That was then acquired by MSCI. And then we were acquired from MSCI by our now owner, as our CEO, Peter de Boer. We were an employee-owned private company, acquired business in 2016, and then that's how we exist today. The couple of notable acquisitions we made in the last couple of years. 2016, we acquired the S&P Equity and Fund Research business. This is predominantly for wealth management investors, and that's like a history going back to 1927, as you can see. And then just last year we acquired the First Bridge data. It was an ETF data set that's available to our clients as well. Brief background on our clients. CFRA is well known for looking after hedge funds. People predominantly think that's what we do, but that's not what we only do. We do look after long-short hedge funds, but we also look after many different other client types and investment strategies you can see down the right-hand side. So it could be long-only asset managers, mutual funds, pension funds. We also look after many different investor types or regulators. We will look after accounting FTSE firms using our services, academics, libraries, D&O insurance companies and the like. So there's various different types of investors or clients that we will be looking after. And the last slide from me here, a bit of background on the few different products that we have from the forensic accounting suite. We do have 25 dedicated analysts whose job is to identify and find these companies, and they're predominantly working across our advisory or our accounting lens services. The accounting lens service will provide forensic accounting research. The flagship product we have is something termed our biggest concern list, which is a list of stocks that we flag that you should be avoiding, or you can take short positions if you have those means. That list of stocks as a dummy portfolio is tracked on the performance of those stocks, and the ideas that we're recommending has got back a long history of performance we can show to people who may be interested after the presentation. We also provide industry research as well as earnings and quality cash flow quantitative scores as well that's available. As part of the advisory services, we have a bespoke service which is customized, where a client can come to us and ask us to do due diligence research on any company anywhere in the world, where we will go through and provide an analysis back on a custom basis to that client. The custom research can also be provided in a comprehensive library of bespoke research that can be made available to those who are interested in that, in looking what other people are ask us to do the analysis on different companies. We also provide a academic kind of training. This is a presentation today that can be made available for in-person seminars. We have various different seminars that are available, as well as an accounting help desk that's available made available for clients who may want to ask us on any kind of different accounting issues they want help on. We can go through again on any company. We also provide risk mitigation, a kind of a portfolio monitoring system as well that's available to clients, where we can assess the risk within a client's portfolio. I will now hand over to David to go through the actual cash flow and leverage part of the presentation here.
Thank you, Giles, and thank you all for joining today. Let's get into it. Today we're taking a deeper look at cash flow and leverage. And the reason why we're doing this is that reported metrics often do not tell the full story. There are limitations to screening and reported trends, which means that we often have to do a manual review of company reports, scrubbing certain metrics, including cash flow and leverage. And of course, these metrics are all the more important in today's COVID-19 environment. Businesses are affected differently. Some are doing fine and others are totally shut down. Zoom versus restaurants. We're not here today to tell you which industries or sub-industries will do better or worse during COVID-19. But we are here today to help you better analyze pre-COVID-19 underlying trends, as well as give you some things to look for as we start getting more Q1 results from companies. This is a time of exceptional uncertainty. Case in point, one European company, Landis & Gyr, they put out a press release after the market closed on Friday, March 27th. They guided down expectations and commented on free cash flow, which I've highlighted in this screenshot. They said free cash flow is subject to the usual uncertainties on the timing of receipts from customers, which is exacerbated by COVID-19 uncertainties. And the interesting thing about this comment is that Landis & Gyr is a March 31st fiscal year end, meaning that there were only 2 business days remaining in the fiscal year when they said this. And still, the company cited the usual uncertainties and COVID-19 uncertainties relating to free cash flow. So there seems to be a lot of uncertainty about cash flows, even among companies themselves. Given this uncertainty, it's no surprise that many companies are tapping their financing facilities. We at CFRA, we reviewed 8K filings at U.S. industrial companies and found 92 such companies that borrowed against credit lines or term loans from March 1st to April 17th, 2020. 40 of those 92 companies drew the full amount or close to the full amount available under the facilities. The average amount of the borrowings represented 33% of shareholders' equity, and not surprisingly, multiple filings of the action was as a precautionary measure or out of an abundance of caution. This chart shows word search hits that identify a filing that relates to accessing credit. So this chart goes back a few years, and not surprisingly, we see a surge in hits, which have almost quadrupled from the normal levels in the last 6 weeks. So just one more data point showing the newfound focus on liquidity given the uncertainty with cash flows. And with that, let's move on to cash flow. Today I'll be discussing 4 things to look for that can affect reported cash flows. 2 of these things you can find directly on the face of the cash flow statement. The other 2 are found in the footnotes, so they take a little bit more time. The first relates to interest paid and interest received. Under IFRS, interest paid is included in cash flow from operations. We have the CFFO acronym here, or CFFF. And interest received is in operating or investing. See here on the screenshot on the right side of this slide, interest received is an investing activity at this company. Interest paid included in the financing section of the cash flow statement. It does need to be consistent from period to period. We generally consider interest payments to be an operating item. And the one thing you would need to do with peer groups who report under IFRS is you want to make sure that you're comparing apples to apples. So just to enhance comparability among peers. Now, this is less of an issue under companies that file under US GAAP, as interest paid and received is included in the operating section of the cash flow statement. We also want to look at lease payments. For IFRS filers, principal lease payments are included in the financing section of the cash flow statement following the adoption of IFRS 16 in 2019. Now you'll see this screenshot on the right, the second highlighted line down at the bottom, payments on principal portion of lease liabilities. In 2018, you'll see this was a 0. There were still cash flows going out the door for these lease payments, but they were considered operating at that time because they were operating leases. Now in 2019, we have 17.6 million as a cash outflow in financing. We also have interest paid on lease liabilities, in this case, in the financing section of the cash flow statement. It could also be in operating. At US GAAP filers, lease payments may be in operating or financing depending on the classification of the lease. We generally would include lease payments in our free cash flow calculation. And so that means that we just have to scan the cash flow statement to make sure that any lease payments anywhere in the cash flow statement are included in free cash flow. And that means that a simple free cash flow screen comparing US filers to IFRS filers may be misleading. Moving on to receivables factoring. Now, this is something that you do have to look in the footnotes for. It takes a little bit more effort to drill down on this. What is receivables factoring? Well, it's where a company sells receivables usually at a slight discount, and that discount is the factoring cost. Factoring is also known as, or similar to, discounting, selling receivables, or securitizing. There's really nothing inherently wrong with factoring, but it's one of the first things that I look at as I look at company reports, because it can have such a profound effect on the reported day sales outstanding, cash flow from operations, and net debt. So selling receivables inflates your operating cash flow if two conditions are met. And those two conditions are the factored receivables are derecognized, i.e. they are removed from the balance sheet, and the balance of sold receivables outstanding increases in the period. You could have a situation where the factored receivables are derecognized, but the balance stays relatively flat over time. And in that case, it's not necessarily a cash flow boost. Now, when we look at disclosure for receivables factoring, disclosure sadly is, it varies, and sometimes it's not very good. Boilerplate language about factoring might be the only disclosure that you have in a company's annual reports. Sometimes you might have the factoring cost disclosed in the footnote on finance costs. Some companies will tell you the amount of receivables sold during the period. And then other companies will tell you the amount sold and outstanding at period end. And this is what we really want, is it allows for adjustment of our day sales outstanding and our cash flow metrics. Some companies, as I mentioned, will not disclose much quantitatively ever. Sometimes you'll get a sporadic one-off disclosure of a number. And then sometimes you'll have companies that disclose factoring every period. And that's, of course, what we would like. Where to look for disclosures? Well, we would look in the footnote or discussion on receivables, cash flow, or liquidity. Those are the prime places to look. Word searches also can be effective in looking for receivables factoring. Look for the word derecognize or factor or selling receivables. And then sometimes you can just ask the company if there's nothing disclosed. Some companies will tell you there was no factoring, or factoring is up or down, or they may not tell you anything. So what does disclosure look like at a typical company? Treehouse Foods in the US, this is their disclosure on factoring. The first highlighted clause here, it says receivables sold under the program are derecognized. So that's that first condition that I mentioned that we really care about, i.e. the receivables are removed from the balance sheet. And if they were not removed, then it really is not an issue for us, as it does not inflate operating cash flow if those receivables are factored but remain on the balance sheet. But here they are derecognized. That second clause, the outstanding amount of accounts receivable sold under the receivable sales program was $243 million and $177 million at December 19 versus December 18. So the boost to operating cash flow is the increase in this outstanding balance. So in this case, $66 million. And one other point of disclosure here, I think it's an interesting comment. Some companies, when they sell their receivables, they continue to service those receivables, and they may collect the cash on those serviced receivables, but hold it for a period of time before remitting it to the financial institutions who hold the receivables. And in this case, Treehouse, they tell you what that pass-through amount of held cash is. That's a topic for another day. It can add another layer of adjustments, but it's an interesting disclosure. So how do we assess the boost of receivables factoring? Here, this table shows the operating cash flow from continuing operations, but I would point you first to the bottom row in this table, the balance of sold receivables outstanding. In fiscal 17, it was $74 million, and I should say in 2016, it was 0. So it's introduced the end of that year in fiscal 17, it goes to $74 million. And then the next year, the balance of sold receivables goes to $177 and then $243. And the increase in every year is the benefit to your operating cash flow. If you look at fiscal 19, there was a $66 million cash flow benefit, and that equates to 25% of operating cash flow in fiscal 19. Over the 3-year period, it's a 20% of the reported operating cash flows related to receivables factoring. So if you care about really drilling down to a company's underlying operating cash flow and free cash flow, you really have to look for factoring facilities, as they can have profound effects on what that number is, here 20%. Now, the next thing I'm going to be talking about are receivables, accounts payable programs. These payable programs are also known as reverse factoring or supplier financing, and they're becoming a lot more popular. By way of background, what happens is, instead of a company paying a supplier directly, a bank or financial institution pays the supplier. The company then owes the bank, and that liability will appear on the company's balance sheet as a payable or a borrowing. The company pays the bank, and the cash outflow may be an operating cash outflow or a financing cash outflow. And this may allow for the extension of a company's supplier payment terms without subjecting the supplier to receiving the cash later. And it may enable the supplier to use the company's credit in accessing financing. I should note that payables programs can take different forms, and the disclosure is not always clear. Here's a nice comment from Kellogg's CFO a few years ago, talking about the benefits of payables programs. And he said, effectively what supplier financing does is it allows you to extend your payment dates with suppliers, but it does allow the suppliers access to cash through a third party at a nominal cost of money, so they get their cash sooner. So we believe this and know that this will provide great benefits to our working capital, about $200 million to $300 million, and should reduce our debt levels slightly versus what we previously expected. So to summarize, longer payment terms with suppliers get cash sooner, working capital benefits, and there's lower debt. Everybody wins. Now, the disclosures for accounts payable programs, they vary a little bit, but here's the disclosure at Keurig Dr. Pepper. Let me just read from the first highlighted sentence there. It says, we work with our suppliers to optimize our terms and conditions, which include the extension of payment terms. And then they say the current payment terms with our suppliers generally range from 10 to 360 days. So almost a year. Just think of that. It's a pretty astonishing number. Moving on, they say suppliers can sell one or more of our payment obligations at their sole discretion, and our rights and obligations to our suppliers are not impacted. And then moving on, our obligations to our suppliers, including amounts due and scheduled payment terms, are not impacted. Now, because the terms are not impacted, the payable remains a payable when it, I should say, instead of becoming a borrowing. And so that helps with the leverage because that liability does not affect net debt. I would also point out that there was surging usage of this payables program. We see 2.1 billion as of the end of 19 versus 1.4 billion as of the end of 18. So a big increase in the usage of this payables program at Keurig Dr. Pepper. Now, how does this affect cash flow? This table, this shows the day sales in payables, and we see DSP increased to 226 days as of the fourth quarter of 2019, up from 168 days last year. Now, in this scenario, it's important to know what's going on. This operating cash flow benefit is due to timing, but it's not due to location of the cash outflows, i.e. the cash outflows remain operating cash outflows. The timing is affected. This payables program accounted for 66% of the payables balance. You'll see as of 4Q19, again, that payables program component was 2.1 billion. The total accounts payable on the balance sheet is 3.2 billion. So it's a big deal for this company. And then if you look at the year-over-year increase in that accounts payable program component, again, it went from 1.4 billion to 2.1 billion. So 659 million increase in the balance of payables sold from vendors to financial institutions. And that's about 27% of this company's reported operating cash flow in fiscal 19. Now, another way to do this math would be to look at the increase in your day sales payable total and maybe net out the increase in your DSI. Either way, it's a pretty big number here in this scenario with Keurig Dr. Pepper. Now, in contrast to Keurig Dr. Pepper, this is an example of a company that does it a little bit differently. This is a Chinese pharmaceutical distributor called Sinopharm. And let me read from their disclosure, from their reports. They say they have an accounts receivable financing program with certain banks whereby the banks repaid accounts payable on behalf of the group with an equivalent sum drawn as borrowings. And then it says the repayment of the borrowings in cash is accounted for as a financing cash outflow. So this is a critical thing. They're saying here that unlike Keurig Dr. Pepper, where the benefit is a timing benefit, this results in a change in the location of the cash outflows. Now the cash that would have gone out the door through operating is now going out the door through financing. Accounts payable that were satisfied under this program in 2019 amounted to 2.2 billion. But interestingly, the ending balance was only 186 million at year end. So remember that payables versus borrowings classification issue is really of little import here from a leverage perspective of Sinopharm, because the borrowings on the balance sheet are basically negligible at year end. So the major impact here at Sinopharm is on cash flow. And if you look at Sinopharm's cash flow over the last 8 years, it tells a pretty dramatic story. The column on the right side of this table shows the cumulative cash flows for the 8-year period. You'll see operating cash flows 62.8 billion. But if you go down a little bit, you'll see there's a row here for the payables financing program benefit, 29.2 billion. So this is to say that over the last 8 years, 29.2 billion in cash flows went out through financing that otherwise, in the absence of this payables program, would have been cash outflows in the operating section. I would also point out here that in fiscal 19, their operating cash flows surged to 18.8 billion. You can see historically they've never been even close to that. But if you look at it a little bit deeper, you'll see there was a 2.2 billion benefit from the payables financing program in 2019, and then astonishingly a 17.4 billion benefit from a surge in factoring in 2019. Now, when the company was talking about the year-over-year increase in operating cash flow, they said it effectively demonstrated the group's business concept of high quality and sustainable development. There are words I would use to describe this operating cash flow increase, but high quality and sustainable are not words I would choose. Let's get into looking at leverage. We're going to look at net debt to EBITDA at ACS. Now, ACS is a Spanish construction firm, And they recently described their net debt as, quote, virtually non-existent. This is a screenshot from their release. They say their net debt is about 54 million euros or 0.02 times annualized EBITDA, virtually non-existent. But let's ask the question, what is included in that net debt calculation? This is their balance sheet presentation, and I've gone ahead and highlighted 4 line items on their balance sheet, which sum to their estimate of 54 million in net debt. The first is cash. The second is the other current financial assets, a portion of which I would comment includes equity in instruments and loans to associates. It's not clear how liquid those would be. They also include long-term financial liabilities and short-term financial liabilities in their estimate of net debt. But what is not included in net debt? This is probably the more important question. The first thing we can do is just look straight again at the balance sheet. Look at it a little bit closer. I've gone ahead and highlighted some of these lines in red. The first, long-term provisions. A significant component of long-term provisions relates to pension provisions, 428 million for an underfunded pension. They also have lease liabilities on the balance sheet, operating lease liabilities, short-term and long-term. And then also they have this liability, it's called a financial liability related to BICC. Now, what is that? Well, that relates to financial guarantees on borrowings of a troubled associate, BICC, that ACS now expects to pay. And they even call it a financial liability. That's their language, but they don't include it in their definition of net debt. If we drill down into the footnotes a little bit, we see that there's a comment on receivables factoring. We see securitization outstanding, parentheses factoring amounted to 2.2 billion as of fiscal 19 year end. And remember, receivables factoring accelerates cash collection, so that boosts your cash balance, and the higher cash balance flatters net debt. And then back to the payables programs issue. Is the liability really, is it a payable or is it a borrowing? And there's some blurred lines here. They say in their disclosure, supply chain financing at 2019 year end amounted to 1.5 billion. And then they say the use of these financial instruments, interesting term, on the part of the suppliers does not mean a change in the contractual conditions and maintains the original liability, that therefore is still booked under the commercial creditors accounts. That translation, payables. So again, I would reiterate that companies may stretch the normal payment terms with vendors so that usage of the payables programs does not alter the normal terms. And that would justify continued classification of the liabilities as payables instead of borrowings. No disclosure of terms at ACS, but remember that 360-day term disclosure at Keurig Dr. Pepper. I would also note this is an area of judgment. So if we look at the numbers again, the first 4 rows in this table, these are, again, the items that ACS included in their definition of net debt, and that would get you to 54 million in net debt. But if you include the operating lease liabilities, the financial liabilities related to BICC, that pension provision, the receivables factoring, and the payables factoring, remember that payables factoring comment from Kellogg, where they talked about one of the benefits of payables factoring is the lower debt. Well, here's where the rubber meets the road. Well, you get to net debt of 6.1 billion or net debt to EBITDA of 1.9. Now, that's a manageable level, but is it virtually non-existent? No, we would say it's not. The other thing I would say here is, in this case right now, I'm not adjusting anything on the EBITDA side of this. And if you know anything about us, we oftentimes will do a quality of earnings check, looking at any kind of reversals or gains, basically trying to scrub that EBITDA metric as well. But we don't do that here, but that's one thing that we should be doing. And with that, I will toss it back to Giles.
Yeah, thank you, David. We go back up a slide. Given the current environment and the focus on cash flow and leverage as of a real concern, we have the CFRA team and the analysts have produced many different industry reports looking at issues across different sectors in Europe and across the US. And I just wanted to flag a few. companies that have highlighted in these reports, that just to make sure you can see where our concerns, as we see the concerns. So within the European consumer space, we had a focus on weak cash flow and high net debt to EBITDA, and the companies that flagged there are Anheuser-Busch, InBev, and Casino. Within the US consumer space, we focused on leverage. Keurig Dr Pepper again, and Heinz Celestial companies that flagged there. Within the industrial space, companies scrambling to access liquidity. A couple of stocks that probably may not be such a surprise were Ford, GM, and Boeing. Within the European space, we had a focus report on factoring and reverse factoring. Stocks flagged to include ACS, you've seen there, Alstom, Fincantieri from Italy, John Wood, Thales, and Vestas Wind. We also did one in the financial space within Europe, review the liquidity metrics there. SocGen, ING, KBC, and HSBC were stocks that flagged from our financials team. And within the healthcare space, we had a checkup on cash flow and leverage, and Health Equity, HQY, and Eurofins were stocks that are flagged from the healthcare space. These reports are available to all our clients. If you're not a client and you'd like to get more details on these stocks or reports, then please come back to us and we can see what we can do to help. That's the end of the standard part of the presentation. We are a little up on time. We've got time for maybe one or two questions. If I could pose these back to David. I've got one question here I can put to you, David. Is it possible to screen for cash flow games?
Well, I would say that a lot of cash flow games really are not captured in a quant screen. For example, if you have a company that shows a decline in their day sales outstanding, in the receivables, if you look, there's really no way for a screen to distinguish between that decline being from cash collections from customers or receivables factoring. Quant screens just can't do that. You really have to look at the footnotes. I mean, word search screens may help, but you really have to dig in closer on that. I would say a quant screen would be able to catch something like an increase in your day sales and payables, which might mean that a company might be doing some reverse factoring, but not necessarily. So really, quant screens are a starting point, but there's really a lot more to it than just screens.
Sure it is. Okay, that's great. We've got time for one more, if you may, David. And this one's for you. Is it always a cash flow boost if a company starts reverse factoring?
So I would say it's almost always a boost to your operating cash flow when a company starts reverse factoring, because we see the day sales and payables generally increase. That is our experience. I guess it is possible to have a company that does engage in reverse factoring. After a period of time, maybe it reaches a steady state, and that increase in DSP, basically it flattens out. And at that point, you might not be getting a cash flow boost in every period from your reverse factoring.
Okay. Thank you very much, David. I think we're probably up on time. We've run over a little bit. So there are other questions I can see, but we won't have time to get to these. So if there are other questions you still want to submit, please send them through. We will get back to you individually on the questions you pose. And also state there is a recording going to be available on this if you've missed any of it, would like to recap on it. So thank you everyone for your time. Appreciate it on a Friday, and goodbye.